Hello everyone. Today we are discussing the classification of mutual funds. In the previous video, we were discussing what is the meaning of mutual funds. Mutual funds means it is a pool of money which is collected from number of investors and which is invested in using a diversified portfolio with the help of asset management company managed professionally, so the risk is less associated with mutual funds. Now we are discussing the types of mutual funds. So basically, when we discuss the mutual funds can be classified on two main bases. It can be classified on the basis of structure and it can be classified on the basis of investment objectives also. So let us discuss in detail what are the different types involved under on the basis of structure and on the basis of investment objectives. Types of mutual funds by structure. There are three types of mutual funds on the basis of structure: close-ended funds, open-ended funds, and interval schemes. So let us discuss close-ended funds. Close-ended funds means here a fund which is open for subscription during the launch and only it is available for certain period of time. Certain amount of time will be given or will be available for subscription. So here there is a limit while subscribing and also while investing under close-ended funds. So here mutual fund investors who are willing to invest in close-ended funds, they will be able to invest their funds only during the time which is given for launch. And this type of mutual funds will have a specific timeline, whereas it will have a specific timeline, and on that timeline, the mutual funds will be matured. So, these funds, when you're investing in these funds, there are certain things or certain things you need to know. So, first thing is the close-ended funds are listed on stock exchange and the investors can sell their units on the stock exchange and they can also uh, get their mutual funds back at the net asset value. So before we move further, you should know what is net asset value. If I tell you in simple terms, net asset value is the value or the market price of the securities after deducting all the expenses of related to that particular funds. So it is the market price of the securities, and same net asset value will be used further once the maturity period is done. Okay. So let's discuss certain things related to the transaction related to close-ended funds. So when we are dealing with close-ended funds, either we can purchase or sell those funds. So all close-ended funds will mature within specified period of time, and the specified period of time can be anything between 2 to 7 years. So there is a time band that is between 2 to 7 years. At any time it can mature. And the close-ended funds, the investor will be required to purchase additional units from the secondary market, and this stock exchange, this the investor what they are going to purchase the additional units that will be from the stock exchange and it is listed. Okay. Similarly, the investor who is willing to sell their securities, they are also required to sell them in the secondary market, and that is in the stock exchange. And another option is also available, either to buy or to sell, or another option which is available, that is buyback of the funds and buyback to the asset management company. So these are the certain things related to the transaction. As I told, these transaction or the close-ended maturity will happen between 2 to 7 years, and the transaction, all transaction will happen in secondary market, that is in stock exchange. But if it is buyback, then it is managed by asset management company. But still, asset management companies also purchase units from the investors in the secondary market. Okay, so this is the first type related to the mutual fund by structure, that is close-ended funds. We are moving further with the second option, that is open-ended funds. Okay, what is this open-ended funds? Open-ended funds will not have maturity period. Now, just now we discussed close-ended funds where there was maturity period, that is between 7 to 11 years, 2 to 7 years. Whereas open-ended funds, they don't have any maturity period. And the investors who are willing to purchase and repurchase them, whatever, or if they're willing to purchase or sell, they are allowed to do that. There is no time span related to maturity period. Now, when the transaction, either it is selling of their units or buying the units, the transaction will happen at net asset value. This is one of the important thing, that is on the market value on that specific period. What is the market value? On that basis, the transaction will happen. Okay. Further, during the launch period of the mutual funds, if the units are sold, then it will be on the face value. Remember, if it is during the launch period, if this transaction happens, then it is at face value. And if it is after the launch, if once the launch period is completed, if the transaction happens after that, then the mutual funds will be available for sale at the net asset value. So, if any transaction after mutual funds, if it is happening, then the price is based on net asset value, I told. So, on monthly or quarterly basis, the investors, they will receive the information related to their transaction and what is the asset value of their holdings. Even that information they will get on monthly and quarterly basis in statement form. And the increase and decrease in net asset value, that will impact on the price fluctuations of the securities. So depending upon that, the managers can invest in their securities. Okay. Then a portion, in case of the funds which are open ended, a portion of the investments of the fund are in liquid securities. Liquid securities means the securities, or liquidity means your ability to convert the money or funds into cash. So a portion will be into liquid securities, and there will be diversification. So based on that, the funds will be distributed even in open-ended funds. Then, when we are discussing about open-ended and closed-ended, we need to make a note of The difference between open-ended and closed-ended funds, the main difference is the number of units. In case of closed-ended mutual funds, the number of units are fixed. But in case of open-ended funds, the number of units are not fixed. That means the mutual fund can issue more units if there are high amount of investors, higher number of investors who are ready to invest, and they can issue less number of units if there is less number of investors who are investing in the funds. Okay. So these are the basic main two types under by structure, and there is third type, that is interval scheme. The interval scheme is quite different from open-ended and closed-ended uh, funds. Interval scheme, from time to time at various period, make offers from repurchase of the units, and that will be held by the fund investors. The funds which are they are going to purchase, that is also on the basis of net asset value. So one of the important thing you need to notice is the interval funds are not traded in the secondary market. Previously, when we were discussing about close-ended funds, they were traded in secondary market, whereas you should make a note that interval funds are not traded under secondary market. Then the period when the offers for repurchase would be made, it will be mentioned in the prospectus. I told about repurchase, and when the repurchase happens, that will be mentioned in the prospectus. Now, what is the meaning of prospectus? Prospectus is a document which will be given at the beginning, which will be issued at the beginning when they are going to launch the funds, and all the details related to the funds will be mentioned in this document, that is mentioned in the prospectus. Okay, what are the documents or what are the information the prospectus gives? It can be related to investment objective, or what is the investment strategy they are following, that information, or what are the risks associated in the investment, what are the fees and expenses which they are supposed to pay, and the performance of the various schemes or units holders information, that is the investors information. All these things will be mentioned in the prospectus, and as I told, the information related to repurchase and what is the period and when it happens, that also information will be mentioned under prospectus. Okay, so these are the certain things related to interval funds, and further we are moving with the next type, that is on the basis of objective. So next we are discussing the types of mutual funds by investment objective. So here basically we have classified on the basis of we have classified the mutual funds into four types. We'll discuss each types one by one. First one, growth fund. Growth fund thinks about these kind of investments are mainly concerned about capital appreciation. Okay, so funds where the investments are made with capital appreciation, that is known as growth funds. So here their main purpose is capital appreciation, and at the same time you should know one more thing, that these funds do not pay any dividend. They will not pay dividend. They concentrate on appreciation. So here the funds which are invested in companies, and here the company will be more concerned about growing with their increase in the profit. So increase in the profits is their main objective, and the fund manager would expect the company to grow at higher rate, and when they grow at higher rate, it gives large capital gain to the investors of the growth fund, and they will get the returns from it. Okay, but in this case, in case of growth fund, the risk level is high because it expects high return, and it is growth fund which will be kept for a longer period of time, which includes higher risk, higher return. And uh, here the investments who are going to do the investments, they will be the risk seekers who are ready to take the risk. That is in case of growth fund. Next type we have, that is income fund. Income fund is quite opposite to growth fund. That means here income fund, as the name suggests, it is something related to the regular income. The income funds earns regular income for their investors, and when they invest the money, the funds are invested in such a way that they get higher percentage of their funds uh, are invested in fixed income, so that they receive the money, and the more proportion goes to fixed income and money market rather than having other investment avenues. Okay, so here regular income is expected, means here the investor, the whatever income is earned, that will be given to the investors in form of dividends, and the income funds are for the investors who are risk averse, who are uh, not ready to take the risk. For them, the income fund, these type of mutual funds are meant for them. Okay, uh, and here the main aim is to get regular income. Next, the third type what we are having is balanced fund. Balanced fund is having the balance of both growth fund and income fund. Okay, so here they expect the regular income also. At the same time, they also, the investors are also concerned about capital appreciation. So they invest in equities as well as in debt and money market instruments. So that gives them the balanced kind of returns. Here, as I told, the funds what they're investing in equities, at the same time fixed income instruments, and also in preferred equities, which gives them the dividend at the same time, which provides them the interest and also the profit from the increase in the investment value. This is one of the best option which is meant for the investors. So here, though for certain proportions they are taking the risk and they are getting higher returns also, at the same time for some other proportions they are also having the fixed income where the risk is very low. Okay, next we have the next type, the last type under investment objective is money market funds. Money market funds are meant for liquidity. That means the capacity to convert the money into cash within very less period of time. So here they aim at liquidity, capital protection, and generating income. So the investments what they made into liquid investment products like money market schemes, and we can discuss some of the secured instruments under this. So it is kept for shorter period of time, and this short term maturity may include treasury bills, So, what is the meaning of treasury bills? Treasury bills means it is government issued short term debt security, and within a year, government will pay back the amount with interest. So, uh, under money market, either they can invest in treasury bills or they can invest in a certificate of deposit where it is similar to FD, but where you get higher amount of interest comparing to the interest what is paid by the bank on fixed deposit. But even commercial document is also, sorry, it gives you the fixed amount of interest at higher rate. Then we have commercial papers. Commercial papers are also uh, a unsecured but short-term debt instrument which is issued that also gives the regular income, and it is kept for short-term period of time. So these are coming under money market funds. So we have discussed the types of mutual funds by investment objective. So if a person is ready to take the risk, then he can think about growth funds. If the investor is risk averse, then income fund is meant for him. And at the same time, balance funds, which gives more returns, which includes the capital appreciation and at the same time regular income also. And money market funds, which mainly thinks about liquidity, where it is invested for short term period of time. So these are the types of mutual funds. Moving further, we have certain benefits of mutual funds. We'll quickly discuss what are the benefits of mutual funds. First, we have portfolio diversification here. Uh, when we are investing the funds in different avenues, there will be different options available, and the investment is done in such a way that depending upon different investment objectives, the funds are distributed in different options or different securities like stock, or it can be on the debts, or in uh, also in treasury bills, commercial papers, etc. Then, second point, professional management, where uh, even the small investor who has less amount of money also can make the investment, and there will be a qualified person, or it will be managed by professionally by the fund manager. So the level of risk is less. Then risk diversification, where here there is an option to invest in different avenues, and according to the investment objective, the risk can be minimized by the investors through diversification. Then reduced transaction cost, where here the transaction cost volume will be comparatively less, and the more benefit will be, lesser cost will be deducted, lesser cost will be charged, at the same time more benefit will be transferred to the investors. Then affordability, even small investors can think about getting this facility, because it is a small, it is an arrangement where the small amount of money will be collected from number of investors. So it is having the affordability, at the same time well regulated. The there is SEBI who is going to supervise all the transactions, so it is highly regulated, and the uh, safety is given to the investors. Then the choice of scheme, there are number of plans, variety of plans available for the investors under mutual funds. So the choice can be done, choice of scheme can be done by the investors depending upon their investment objective. So, this is all about mutual funds. Thank you.